Hi everyone! In this episode, we're examining a topic that is fundamental to your success in managing risk, but also one that's often approached in ways that can be, frankly, naive. We're going to dissect naive methods of risk analysis in project portfolio management, why they're problematic, how they can lead to costly mistakes, and what we can do to move beyond them. Now, when we talk about naive risk analysis methods, we're referring to those overly simplistic approaches that don't account for the true complexity of managing risks in a project portfolio. The typical steps, identifying risks, assessing them, and developing mitigation strategies, are foundational. Yes, but they can also be applied in very superficial ways. When these steps are followed with a lack of depth, we end up with gaps in understanding that leave our projects vulnerable. So let's break this down, starting with risk identification, which is often the first place where naive approaches take hold. In the naive approach, risk identification might involve a few people in a room brainstorming potential risks or using a basic checklist of common risks. Sounds reasonable, right? The problem is that this method relies heavily on gut feelings, assumptions, and surface-level thinking. For example, someone might say, well, this project is similar to one we did last year, and that went smoothly. I don't foresee any major risks. That's a dangerous assumption. Why? Because it ignores the nuances of the current project's context, like changes in the market, new technologies, or shifts in team composition that could introduce entirely new risks. Let's look at it as an example. Suppose you're managing a portfolio of construction projects. You've built similar structures before, so you assume that the risks are the same. Budget overruns, material delays, and maybe a few weather-related issues. But what if one of these projects is in a region that recently passed stricter building codes? If you don't dig deeper, you might completely miss the risk of regulatory compliance, which could cause major delays or fines. This is a classic case of naive risk identification, focusing on what's been true in the past without considering the unique circumstances of the present project. Moreover, naive risk identification often lacks input from all the key stakeholders. It's easy to fall into the trap of assuming that a handful of project managers or team leads can adequately identify all potential risks. But what about the perspective of the procurement team, or the IT department, or even external vendors? Naive approaches often miss this crucial collaborative element, meaning that certain risks go undetected simply because the right people weren't in the room. Moving on to risk assessment, this is another area where the naive approach falls short. After identifying risks, let's say you've listed 20 potential risks, the next step is to assess their likelihood and impact. The naive approach often treats this as a quick, subjective exercise. Team members might estimate a risk's likelihood based on vague impressions or past experience without any supporting data. For example, someone might say, I think there's about a 20% chance we'll go over budget because we've done similar projects before and managed to stay on track. But where does that number come from? Is it based on real data or just a gut feeling? Here's a common mistake. Instead of using data-driven insights to assess risks, the naive approach often involves people making educated guesses about the probability of risks occurring and their potential impact. This can lead to severe underestimations. Imagine you're managing a software project, and your team identifies the risk of a security breach due to third-party vendors. If your assessment is based on the assumption that breaches are rare, because it hasn't happened before in your previous projects, you might rate the likelihood as low. But if you had taken a deeper dive into industry data or consulted your cybersecurity team, you'd realize that third-party vendor breaches have become far more common, and the potential impact on your project could be devastating. A naive risk assessment also tends to treat risks in isolation, without recognizing the interconnected nature of risks in a portfolio. Let's say you're managing multiple projects that all share resources, whether that's personnel, technology, or budgets. If you assess the risks of a resource shortage in one project without considering how it might affect other projects in the portfolio, you're not seeing the bigger picture. A resource constraint in Project A could easily create cascading delays in Projects B and C. But the naive approach would treat each project's risk as a separate, standalone issue. This siloed thinking can lead to bigger problems down the line when multiple projects begin to encounter the same risk, all because it wasn't properly assessed at the portfolio level. Finally, let's talk about risk mitigation strategies, the third step in this naive process. In a naive approach, mitigation strategies are often generic and reactive rather than proactive and specific to the actual risk environment. After risks are identified and assessed, a common mitigation strategy might be something like, we'll increase the project budget by 10% as a contingency. But here's the problem. Throwing money at a problem doesn't necessarily solve it, especially if the root cause isn't understood. A naive mitigation strategy often doesn't address the underlying causes of the risk. Let's say the risk is related to a potential talent shortage for a highly specialized technical role. Simply allocating more budget won't solve the issue if there's a limited pool of qualified candidates in the market. A more sophisticated approach might involve investing in upskilling your current team or partnering with a specialized recruiting firm to ensure you have the talent pipeline in place when you need it. Another hallmark of naive risk mitigation is the failure to monitor risks continuously. Often risks are identified and mitigated at the beginning of a project, and then everyone moves on. But risks evolve. For example, a risk that seemed low at the start of a project could escalate as conditions change, such as new competitors entering the market or shifts in political regulations. In a naive approach, you won't catch these changes because you've already checked off the risk and moved on. A more effective strategy involves regularly revisiting and reassessing risks throughout the project lifecycle. Let's expand on an example to make this real. Say you are managing a portfolio of digital transformation projects across different departments. You identify a risk early on that some employees might resist adopting new technology. So you plan a series of training sessions to help smooth the transition. That's your initial mitigation strategy. But as the project progresses, new risks emerge. Perhaps an external vendor is struggling to meet deadlines, or a global cybersecurity threat puts your data at risk. If you're following the naive approach, your focus remains on the original mitigation plan, those training sessions, without adjusting for the new risks. And that's how naive methods leave you exposed. They treat risk management as a static process when it should be dynamic and responsive. So, why is all of this naive? It's because these methods oversimplify the reality of risk management. They rely on assumptions rather than data. They ignore the complexity of interconnected risks, and they often approach mitigation as a one-time fix rather than an ongoing process. Naive risk analysis feels easy in the short term, but it leaves you exposed to the very issues you're trying to avoid. The solution? It's about adopting a more thoughtful, data-driven, and collaborative approach. Start by collecting data on similar projects using tools like Monte Carlo simulations or scenario planning to quantify risks and test various outcomes. Engage your entire team from procurement to IT so you get a holistic view of risks across your portfolio. And most importantly, revisit risks throughout the project, continuously adjusting your assessments and mitigation strategies as conditions change. At the end of the day, risk management isn't about avoiding all risks. It's about understanding them deeply, being proactive in addressing them, and staying agile enough to adapt as new risks emerge.